Hey, what's up guys? John here. Is Jerome Powell and Janet Yellen going to get this one right? Are we going to have a perfect soft landing?
I believe there's a path by which the economy could achieve a soft landing. Inflation coming down with the labor market remaining strong.
Where this airplane comes down, lands right on the center line, everybody gets off and they're happy. Inflation's at 2%, unemployment maybe 3.5%. Strong labor market, the real estate market is very strong. Home sellers don't lose money, but yet rents are affordable, and everyone's winning. Or are we walking into something very, very different? Because what the World Bank just warned yesterday is something everyone needs to pay attention to. And when you look at historical patterns, what happened during every single time that they cut rates, it's shocking, and it should not be ignored. Because if you're an investor, you're an American, you may be planning on doing something big in 2024, pay attention to what's going on. Don't read the headlines, read between the lines. Please hit the like button, YouTube will share this content to educate more people about what's happening in the U.S. economy. And if you'd like to fix your credit to position yourself for the greatest wealth transfer in American history, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item under credit report, go to GreatCreditFast.com, click the link in the description just below this video, schedule a free strategy session for tomorrow, Friday, to position yourself for this massive wealth transfer. Take a look at this. So 1989, this is target federal funds rate, right? 1989, they cut rates. When they cut rates, then July 1990 to 1991, that recession hit. So when you look at this, within 6 months, boom, it hit. Then you look right around here. If you look at March 2020, or March 2000 to October 2002, then you go right here, and then boom, the dot-com bubble. Everything hit the fan. Then you look, same right here, 1998, the recession in 1998, right here, 1998, small recession, boom. Then the 2007-2008 crash. 2007-2008 crash, same exact thing, they cut rates dramatically. But what we're walking into now is very interesting because the Fed funds rate is over 5.5%. So when the Fed funds is over 5.5% in that range, and Janet Yellen is saying that, hey, we're going to have a soft landing. I mean, this came out today. She said soft landing for the U.S. economy. She looks very, very happy, like she thinks, yeah, we did it, America. But I put something out on YouTube showing every single, and someone grabbed it and put it on Reddit, every time that they've said soft landing, 1978, 1973, 1989, 2007, 2008, in the 1980s, every single time they said soft landing, the complete opposite happened. They cut rates, and then a recession followed within 6 months, right? Every time. Even Forbes came out and said, 5 predictions for an economic soft landing that were totally wrong. And they took some very similar newspaper clippings, 1973, 73 to 75, and they go on and on to 1980, even the 2007, 2009 crash. All of this, they predicted a soft landing. Now, when you look at what's happened with interest rate hikes, Fed funds rate, we've seen the fastest hike cycle in history. This is only showing to 2022, so they've hiked a little further since then, right? So the fastest in history. Then you have what the World Bank came out with yesterday. This is December 13th, and what they said, World Bank economist warns high interest rates will likely last longer. World Bank chief economist Intermittent Gill on Wednesday said past experience showed that interest rates may stop going up, but they're unlikely to come down anytime soon, which could have a severe negative consequence for developing countries. Gill said steep debt servicing costs, high debt burdens, and slowing growth in many countries raise concerns about a new debt crisis and the risk of contagion when countries default, but said he does not view the risk as imminent. He told reporters that inflation developments look promising in advanced economies, but supply shocks, especially in commodity markets, could raise inflation again quickly, which would put pressure on central banks to keep rates high. So now, am I saying that we're going to have a quick crash that's going to happen immediately? I believe something big is going to happen in 2024. No doubt about that. I think something really big is going to happen in 2024. But I do believe that we could see a lot of people speculating and thinking that, hey, this economy is going to keep booming. Real estate is going to keep booming. Everything is going to be great. And you might see a lot of optimism in the short term. But I think it's going to be a massive rug pull. And I think that this crash is going to be a lot greater than in severity than we've seen in past crashes. And you can already kind of see this with what central banks are doing. Central banks are purchasing gold at record highs. I mean, this is the fastest clip in 55 years that they've been buying gold. Why? Why would they do this if we're going to have a soft landing and everything's going to be good? You have to ask yourself, why would they do it, right? Why would they cut rates and them say that we're going to have multiple cuts in 2024 and everything's going to be okay? Well, when you look at what's going on right now with the dollar, you look at what's happening with oil. Oil rises more than 3% on a weaker dollar, slightly improved 2024 demand outlook, and gold price is booming, almost $2,050 almost. And then you have the Fed funds rate, which they make a very, very interesting prediction here, that they believe that the housing market is actually going to do really, really strong. It's going to be very resilient in 2024 because rates are going to come down, and because of that, buyers' purchasing power will, increase, and because of that, there's going to be more demand to purchase properties. And because of this, people that have 2 to 3% mortgages are going to be less likely to want to sell their property. Now, I believe what's ultimately going to happen is if rates do get cut, we're going to see a flood of home inventory. And that small amount of supply, where home sellers now think that they have a lot of control, even though 22% of all home sellers are slashing prices, that is going to change. There's going to be a lot more inventory to hit the market because a lot of people are going to want to escape their property. A lot of people are fearful. They own a property, they wonder if they're underwater on it. If they think that they can sell and get out, you're going to start seeing a lot of people list their property. Now, if this does in fact happen, and we do see a situation where rates go down, I believe we're going to see home prices crash. I believe we're going to see a flood of home inventory. We're already starting to see it. If you look at the charts here, look at normal cycles in June, July, August. You see home inventory increase because kids are away from school. It's a great time to sell a property, and every time you enter the winter, inventory goes down every single time, except this time. This is dating all the way back to 2016. Every time, June, July, August, then you enter the winter, and then inventory starts to dip. And then every time, winter, inventory starts to dip. Now, this time, interestingly, you have winter here, dipping, and then, boom, now you're walking into the winter, and inventory is increasing. Why? It's because home sellers are looking to get out from underneath of this, and a lot of them are worrying about what's going to happen in the overall economy, what's going to happen in the real estate market, what's going to happen to their job, how are they going to afford insurance and taxes and student loans that are now due, all these different things that are coming. I believe we're going to see a situation where we're going to see a lot more home inventory in 2024. But one of the biggest caveats that nobody's talking about that I think is going to have a massive impact on the labor market is what the economists came out and said. They came out 2 months ago and said corporate America faces $1 trillion debt reckoning. Well, actually, it's closer to $2 trillion. That's a $2 trillion inflation-linked debt, $2 trillion corporate debt wall, right? So Goldman Sachs, $2 trillion corporate debt wall, it's going to spark job losses. But when you look at this, the economists, what they're saying is big American companies are living in debt dreamland. Although cheap borrowing has fueled the growth of corporate profits for decades, the biggest firms have had largely insulated from the effects of the Federal Reserve's recent bout of monetary tightening. That is because many of them borrowed plentiful at low fixed interest rates during the pandemic. The tab must be settled eventually by refinancing debt at a much higher interest rate. For now, though, the so-called maturity wall of debt is falling due looks scalable, right? So when you look at this, these companies that borrowed money at 2% interest rates, 3% interest rates, and now are going to refinance at 7 or 6. That's going to be a big problem. It's going to be a big problem. It's going to spark a lot of companies to look to cut costs. How are they going to cut costs? Layoffs. They're going to be reducing office footprint. They're going to be closing down operations. They're going to do whatever they have to do to try to hold on to their companies. Now, when you're looking at $2 trillion in debt, that's a lot of debt. Even if they cut rates, you think that's going to save them? No, it's not. These companies are in very, very, very big trouble. And it's not just these companies. You have $2 trillion, $2.7 trillion in commercial real estate debt that has to get refinanced in the next couple of years. Are they going to be able to save this economy by cutting rates? Are they? Or are we going to walk into a situation very reminiscent of every other time that they've cut rates? They've never been able to cut rates and save this economy. Never. And when you have the fastest rate hike schedule in history taking place, you have to ask yourself, are we walking into a 2007, 2008 type of scenario? Or is Janet Yellen right? Jerome Powell, are they right? I don't think so. I don't think so. I think the U.S. consumer is in a weaker position today than they've ever been in U.S. history. I think U.S. consumers today can barely afford to go to the grocery store and fill the cart and walk out and not think about the bill. That's what I think. I think a lot of consumers are in very, very, very big trouble, and cutting interest rates, all this is likely going to do is try to delay things a little bit longer, but it's 2024. I don't think they're going to be able to save this thing before the election, even though they're going to try. What do you think? Drop below. Let's have a conversation about this. If you'd like to fix your credit, to position yourself, what I think is going to be the greatest sell-off of assets that we've ever seen in 2024 and 2025, drop below. We'll have a conversation. And if you'd like to fix your credit, to position yourself, we'd love to help fix your credit at GreatCreditFast.com. That's GreatCreditFast.com. You can click the link in the description just below this video. Schedule a free strategy session if you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report. Go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session. Catch you in the next one.